Hi everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account and today's market update. Today, my stock account has an asset of 71,156.42. Today, Apple has closed down 1.23% to 183, and then SQQQ has closed up 0.15%. S&P SPY closed down 0.37. United Natural Gas closed down 15.25%. And let's take a look at the market. Dow Jones closed down 0.62%. Nasdaq negative 0.19%. S&P 500 negative 0.37%. Today, the financial industry and the natural resources, the energy industry all closed with a loss of more than 2%. On the other hand, semiconductors closed higher, led by the gain of NVIDIA and AMD. So first, let's take a look at the U.S. economy. We're going to continue talking about the investors' prospect for the future possibility of interest rate decrease and the hidden risks behind it. So the data for U.S. inflation has shown that the December CPI increase was slightly more than expected and still well above the 3% year-on-year, while the PPI production price index fell month-on-month in December, and bringing the year-on-year growth to just 1%. So the market seems to be increasingly convinced that the Fed is not ending raising interest rates, but will soon start lowering its benchmark interest rates, especially after negative PPI growth. Overall, this is good news, even though they're still being careful with the CPI, but the fact that the PPI have decreased, showing the economy has been slowing from the business side, and then it'll be less burden for the businesses and less likelihood for a recession. The PPI has some advantages in predicting the path of inflation, especially in the current situation. It tends to be better leading indicator, measuring the price changes of various goods at different stages of production, and not measuring residential costs, which is important because the Fed has recently focused especially on service inflation, excluding housing costs. In the Fed's view, the CPI is equivalent rent is lagging behind and could fall behind the course of a year. Therefore, it is hindering the ability of how CPI is reflecting the movement of the economy. And both the Citi and Goldman Sachs have agreed with the Commerce Department of lowering the interest rate in the beginning of 2024, and then start with its plan of quantitative tightening process by the first quarter of 2025. The core PCE is crucial to the Fed, and this data will increase the pressure on policymakers to ease monetary policy as soon as possible. We're sticking to our forecast for the first rate cut in March, but will not expect too much from the Fed if it starts rate cutting by May. The Fed and markets generally agree on rate cuts, but there are some reasons why the downward path of inflation may also be unexpectedly slow. First, the smaller parts of inflation volatility is rather stubborn. Regardless of overall performance, the so-called sticky inflation, including housing costs, car insurance, healthcare services, and household goods, is indeed at high levels. The Atlanta Fed's Sticky Consumer Price Index showed a 4.6% increase in December from a year earlier, down only slightly from November, at a monthly annualized rate. The figure also reached 4.6% from the previous month. In addition, the Fed policymakers are also concerned about the relationship between wages and inflation. Although the current PPI producer price index have shown that the trend may looking more positive. However, the Fed still needs to be making sure that the steady progress towards its 2% inflation goal doesn't mean prices are falling, it just means they're rising at a slower rate. This is all I have for today. We're also going to be talking about the Apple stock performance recently and its external expectations in the next video. So see you next episode.